Hey everyone, today on the Final Bar, I'm talking with Tony Dwyer from Canaccord Genuity. We'll talk about this raging bull market phase in 2023. Market continuing to push higher, S&P up 0.33%. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the tools of the technical analyst. Price, breadth, sentiment, trend, momentum, all of these tell us, I would argue, what investors are thinking, because the best measure of what they're thinking, and really more to the point, what they're feeling, is how they express those emotions in the form of their positions. Buying and selling, excess fear, excess demand, euphoria, desperation, all of those are reflected in prices. That's what our chief technical analyst, John Murphy, has lectured about for decades, and what we continue to apply to the market here day to day. Tony Dwyer is my guest, and I'm really excited to talk with him about the relationship between the yield curve, between recessionary periods, and how excited should we be in early 2023 as stocks are rallying so brilliantly, continuing the rally off the October lows. Good discussion to come here with Tony shortly. Did want to let you know about the upcoming schedule on StockCharts TV and on our show. We just recorded just a little bit ago, earlier today, our 2023 market outlook called Charting Forward 2023. I sat down with Tom Boley of Earnings Beats, Greg Schnell of Osprey Strategic, and Miss Schneider of Market Gauge. You can see more information at stockcharts.com/chartingforward. It's going to air tomorrow morning, Friday, 10:30 a.m. here on StockCharts TV. Next week, three great guests lined up for you. We have Bob Lang from Explosive Options, Dana Lyons from J Lyons Fund Management on Wednesday, then on Thursday the 19th. Tom Boley will be coming through and sharing some of the stocks and charts that are top of mind for him. Let's continue on our show today with our market recap, as I sort of, with a healthy dose of sarcasm and a great deal of skepticism, talk about the raging bull market here so far in 2023. There's no denying the strength that we've seen off the lows in October. You're seeing further upside follow through so far this year. Feels like every week we've seen another group sort of emerge in a position of strength. Today, for example, you have energy reasserting itself to the upside. Airlines all up at the top of the list with American Airlines, UAL, two of the top names in the S&P 500. Cruise lines like RCL and NCLH sort of pushing onward and upward. So you have this condition where individual stocks are certainly pushing higher. Now, our major benchmarks have not quite gone to the party full tilt. You have seen certainly some signs of strength, but the S&P is still trying to get above 4,000. You have the NASDAQ still trying to push higher because the growth stocks that would drive those benchmarks to the upside have not been participating to the degree that you've seen from other areas of the market, places like industrials and materials and elsewhere. If that would change, I think the benchmarks very quickly can rally from here. But again, I'm skeptical of that. Let's look at the evidence and what we saw today, what we learned, and how that relates to the big picture. As I mentioned, the S&P 500 up about 0.33%, pushed toward the 4,000 level earlier in the day, right around lunchtime, but settled back down to close up about 0.33%. The NASDAQ composite finishing right above 11,000. That's up 0.2% from Wednesday's close. Mid caps and small caps both up as well. And small caps, the best performing out of those three indexes, up almost 1.5% or 1.5% today. The VIX, very importantly, I would argue, back below 20. We're going to talk a little later in today's show, a segment called Getting Sentimental, where we focus on some of the major market sentiment indicators. You know, we've been in a period of elevated volatility, right? If you compare what we've seen in 2022 or what we saw in 2022 versus 2021 and some previous cycles, particularly bull market cycles, you saw relatively low volatility with the VIX sort of in the 10 to 15 range. Last year, settling down after the March 2020 pullback, In 2021, for most of the year, we had a relatively low volatility environment with the VIX sort of pushed down again. In 2022, the entire range moved higher, and 20 has essentially been the floor on the VIX since the fourth quarter of 2021. We're potentially breaking that to the downside. And I've mentioned on the show a number of times in recent weeks, we see the market moving higher on lower volatility, the VIX coming down, sort of getting into that steady uptrend mode. That could be a really bullish development. We might be doing it. We'll look at a chart of the VIX together and see what sort of conclusions we want to draw. Interest rates pulling off again here today, with 10-year yields down below 3.5%, long bond yields below 3.6%, bond prices, of course, going higher, and the dollar index coming off. When we recorded our market outlook earlier today, one of the questions I asked our three panelists, are you leaning into non-U.S. stocks or lightening up? Are you adding to a non-U.S. position, or would you consider doing that? And for the most part, of course, it's all about the dollar, right? The strength in the dollar up until October, mid-late last year, strength in the dollar sort of killed any potential returns or certainly minimized the potential returns outside the U.S. Now, all of a sudden, you see the EWG, which is Germany, you see the UK, you see France, you see Italy, you see a lot of these markets starting to show some really constructive patterns, and it's even adjusting for the U.S. dollar because the dollar's been pulling back. So I think the dollar breaking down is maybe a potential real key story for the year, at least in this new year early on. Commodities, for the most part, in the green. Gold and precious metals positive. One of the big takeaways I had from our market outlook this morning was talking about gold and just thinking about gold versus crude oil and the a potential super cycle in commodities, how that relates to what we've seen so far. Equity or energy markets, energy stocks have been rallying really without crude oil being a real part of that. But as we talked about, commodities tend to be sort of a mean reversion play, and weakness in crude oil potentially suggests a nice rotation to the upside. We'll have to see that. Gold continues to be one of the stronger stocks, and in my scan for new 13-week highs earlier this week, a lot of gold names came up in the list, as you might expect. Finally, cryptocurrencies. Bitcoin now above 18,000, and even up to yesterday's show, I kept saying, I'm looking at big key levels. I'm looking at lines in the sand. For me, Bitcoin, 18,000 is it. Unless we can finally get above 18,000, I'm not going to look at that as a potential long idea. It happened. Today we're there, right? We got above there. We got to 19,000. Now that's not up to 64,000, anywhere near the all-time highs by any stretch, but it's showing signs of improvement. And just like you're seeing other risk assets rotate higher, you're starting to see cryptocurrencies have a pretty decent stretch as well. Ether up 3% today, over 1,400. We'll try to get to a chart of that here in a little while if we have time. To wrap up our market recap, let's look at a chart of the S&P 500. I was joking yesterday with my guest, Jeff Hirsch, who's the editor of the Stock Traders Almanac. We were talking about sort of the seasonal tendencies and really suggest strength here in the third year of the presidential cycle, sort of that pre-election year. You tend to have a lot of strength in the first half of the year, lining up very, very well with the early fourth quarter bottom that we had in the S&P, suggesting further upside potential for risk assets. Then not as great in the second half of the year. But for me, it's all about these big key trend lines and levels, right? The line in the sand, as I mentioned, what level would you need to break to turn more constructive? And I was taught, and again, I forget which of my mentors said that, nothing good happens below the 200-day moving average. It was something like that I remember. And also, when you have a trend line that is so explicit, so clear, so clearly matching the trend in the market. And again, you connect the January 2022 high, the March 2022 high, the August 2022 high, the November and December peaks. That's just above current levels, currently around 40, 25, 40, 30, right? So as long as we remain below that long-term trend line, we can certainly have rallies. But how constructive do you want to be if that trend is not violated, right? If that trend line is not followed through to the upside? You may be getting there, right? And today we traded above the 200-day moving average, which is one of the rarities we've seen in the markets in the last 12 months. We closed essentially right at the 200-day, around 39.83. Following through going into this weekend, particularly tomorrow, we have a bunch of earnings coming up, could be a significant sign of upside potential. The other side of that, though, is remember the lows here in October, only 400, 500 points away. That's not too far below current levels. It would not take much to rotate back to the downside. And as we rally, I'm thinking Fed, I'm thinking earnings, I'm thinking a lot of potential headwinds. Hopefully my guest, Tony Dwyer, can help fill me in and fill in the blanks for us on some of those themes. Finally, just to finish off here, we're going to talk about sentiment, but breadth, as you know, is an important part of my toolkit. I want to highlight the fact that all four of the advanced decline lines, looking at the New York Stock Exchange, at large caps, mid caps, and small caps, even though the S&P is well below its peak from late November, early December, all four of those have either just broken above those swing highs today, or they're really close to doing so. If that happens tomorrow, when I'm wrapping up the week, I might have to change these to a bullish green color for the first time in quite some time. That would be sort of change and really representing and recognizing the breadth, the thrust that we've seen off of the October lows. Let's take a quick commercial break. We'll be back with Tony Dwyer of Canaccord Genuity. We'll see you in a minute. Hey, everyone. Welcome back to The Final Bar. This is Dave Keller here at StockCharts.com. It is a pleasure to put on the show for you every day, and we are excited for a lot of really cool things planned for The Final Bar through the course of this year. Our new studio is getting ready. We're warming it up, and we'll be unveiling it here in the next month, and we're super excited to do that for all of you. A couple quick announcements before we bring on Tony Dwyer. First off, we welcome your questions. We had a great mailbag segment on Tuesday. We'll do another one tomorrow. And you can get your questions to us via email, thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll hope to answer one of your questions live on the air on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. Larry Williams put out his market outlook. We have Martin Pring and Bruce Frazier that did their 2023 market outlook. Our Stock Charts market outlook, as I mentioned, our panel discussion is going to be released tomorrow. All of that content and a lot of great guest discussions are available for free at StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. I want to welcome on today's guest, Tony Dwyer. Tony's been a frequent guest on Stock Charts TV and on The Final Bar. He's the chief market strategist at Canaccord Genuity and founder of Dwyer Strategy, coming to us from the New York area. Tony, Happy New Year. Welcome back to the show.
Thanks, Dave. Thanks so much for having me. Always great to be with you.
So it has been a fascinating start to the year. Obviously, we've accelerated off these October lows. You and I compared notes a lot through the course of 2022. I think had similar sort of, bearish, cautious tones to what we're seeing. Now the market appears to be shifting in some way, certainly in terms of the action of stocks. Can you talk to us a little bit about what you're seeing in terms of the market activity, but also thinking a little bigger about the Fed and what it means for risk assets?
So it's interesting, Dave. Last year, there was a couple of big rallies that we pretty well identified. We called it the summer rally and then the year-end rally. And both were generated from significant oversold positions because we're in the context of a bear market. And obviously, I love those charts you just showed on the breadth. There's clearly something different happening here as money's getting put to work. It's amazing how the short basket, meaning those heavily shorted names, are up so far this year. So, the screen that you have on right now, we talk about, are you making a low or the low? Obviously, the market can rally even in the context of a bear market. Remember last summer, you had a couple of, in the middle of the summer toward August, at the peak, we had retraced more than 50% of the S&P decline, and the market had never gone back to new lows when that had happened. Well, until it did. Right. So there is something to be said about the liquidity, but the reason for this chart is this whole year is going to be about whether there's a recession or not. If there's a recession, it would be historically unique for the S&P to have made the low before the recession even began.
Interesting. You're and looking at this table, and then I think your second chart as well, it's thinking about the relationship between the recessionary periods, but also the yield curve. I think the inverted yield curve, I was taught, was one of the big leading indicators. Right. How do we make sense of that here?
So if it's all about the recession, then how do you know when a recession's coming? Well, the orangish areas on that chart are recessions. That horizontal purple line is when you go into an inversion on the 210 yield curve. You don't have to be a master economist to see what it comes after you've gone below the purple line. Now, it can take some time. Remember, this has been 6 months already, but it can take some time. And you can have rallies within that time. But to make the real low, the one where you have high conviction, you wait for it to go back above that purple line.
It's really, really interesting. Next chart is looking at leading economic indicators, and maybe an area that some of our viewers are a little less familiar with. But can you talk about what this means again relative to the yield curve?
The conference board comes up with something called the composite of leading economic indicators. And it includes things like the bond market, the stock market, the economic, all the economic, you put all the soup that we talk about all the time, we make up great formulas for. But this has backdated into the 1950s. Again, I don't need to be a master economist. You've never had a soft landing when it's been at this level. There's always a red shaded area that comes either in or just after you hit the current -4 level. If you think about 1995, which was the last soft landing, or even if you think about 2016, you can see that you didn't go to anywhere near we were this time. So if you look at the 210 curve, which we used on the last chart, if you look at the composite leading economic indicators, they both point very, very clearly to a recession. And if you do have a recession, you have yet to make the low. Again, it doesn't mean you can't have snappy rallies, but that's really the backdrop of how the economic backdrop correlates to the market.
Your last chart here, Tony, is looking at Fed pivots. And I think obviously a lot of eyes on the Fed last year, but looking forward to these first couple meetings of the year. And when we start to see the language transition, what can you tell us about the Fed pivot, a potential Fed pivot, and what that means for stocks after?
It very well may be a sell signal. We're on a run here. The Fed all of a sudden does what we think they're going to do and pivot. They generally do it after a tightening cycle when you're about to go into a recession, with the exception of 1995. When they pivoted and had their first cut there, obviously you kept going. Remember, that was the buildup to the dot-com. We're coming on the breakdown of the dot-com. So if you go back to that chart before, Dave, and you look at the composite leading indicators, where were they in 1995? They were well above where we are now. Go back to the one before that, the yield curve. Where was the yield curve in 1995? Well above where we are now. So the question comes down to, are we going to, in other words, you don't feel like, I'm not telling people they can't trade a good tape. It's a good tape. The breadth is good. The price is good. Just be aware that it might be a temporary move based on the backdrop of qualifying it with a recession.
So, Tony, with all this as a backdrop, when you're thinking about the S&P, the NASDAQ, do you think we've seen the low yet for this cycle? And what sort of conviction do you have on a potential retest of the lows?
Well, I had a conference call today with 150 clients, and I told them straight up, I might be killing you here. You live and die with the data, and the data is very clear. Yeah. When the indicators that I showed here are where they are, we've gone into recession. You've never made the low of the cycle prior to a recession even beginning. Again, you can even go all the way back up almost to the high. People forget, in 2000 and in 2008, we almost made a new high in the middle of the year.
That's right. Yep.
Right. And we'll see what we do here. The Fed has been very adamant that they're not going to play nice in the sandbox until they see the services and labor side come down. And that's not yet happened. So, things right now are okay. You can't disprove the soft landing. We're not in a recession. We'll see where we are by the middle of the year. So our input to our institutional clients is, to stay light and tight. You don't need to make a big downside bet. And when you get these big upside moves, maybe you can lighten it up a little bit.
One of the big questions, Tony, here is inflation, and certainly the commodity markets come to mind, right? You've seen gold all of a sudden start to emerge. Gold was sort of a non-factor, and I feel like if you told you and I before 2022, equities will be in a bear market and inflation will be the main driver, I certainly would be thinking gold is the obvious place you would probably want to go. and it got absolutely crushed. When you see the move, the rotation in gold, does that look interesting to you, or how would that relate to, I mean, if you're thinking about a place to weather, sort of a period of uncertainty, do you look at something like precious metals? Is there a reason why you would not do so?
It's weird.
Yeah.
Right? Like, gold is supposed to rally when there's currency issues globally and there's inflation.
Yeah.
And it got tagged.
Yeah.
So now that we're resolving that problem, it's going up. There's something strange going on with that. And Dave, you've done this, as long as me. You're much better in the commodity side than me because a lot of it trades on the technicals. I'm confused on what's happening with gold. I really am. It should have gone up and it didn't, and now it should go down and it's going up. That shows you what I know on gold.
Well, often I've found the charts will do what they do, and then down the road we'll try to figure out what caused some of those movements.
Yeah, people
Tony,
like me will write a note about it.
Tony, listen, it's awesome to have you on. Thanks for giving us some extra time today. Happy New Year, and we'll look to have you back on again soon.
You're the best, Dave. Thanks, buddy.
That's Tony Dwyer. Tony's the chief strategist at Canaccord Genuity, coming to us from New York. Also the founder of Dwyer Strategy. Does a great job of sharing some of those insights. And, again, it's such a pleasure to talk with people like Tony. Tony understands and knows deeply so much about economic conditions and about what information we should be looking at. And I have found regular conversations with Tony are incredibly illuminating because he takes what I see as a very complex part of market analysis and make it seem super easy. But there's so much rigor that goes behind those comments he's able to make. Great take there from Tony Dwyer. And I love, we're sort of in agreement before the show. I think there's a lot of bullishness coming out on the individual stocks, certainly in ETFs from a technical perspective. The breadth conditions have improved. But let's not forget, nothing's really changed in terms of the relationship between the yield curve and recessionary periods and what tends to happen to risk assets. I love some of those charts that Tony shared with us. I'm going to keep those in mind as we start this earnings season up very soon. Let's continue on our show today with our next segment, Getting Sentimental. We look at some of the sentiment data, see what information it's telling us about the overall conditions. And we're going to start, as we usually do, with the VIX, right? If I look at our sentiment list, and as a reminder, this list that I usually show on Thursday, which is our sentiment list, is part of what I call the morning coffee routine. This is a set of charts that I review every day. And you can get to it if you're a StockCharts member. Go to your dashboard, go to your list of chart lists, and at the very bottom, there's a little gray button that says Manage Chart Packs. If you click on that, you can get all of these chart lists and import them into your account immediately. So we start with the VIX, and again, I've talked about a lot of levels, and for me, I focus a lot on what I call the lines in the sand, right? A level, a signal, a pattern, and I'm basically, instead of having to watch the VIX every day, I just sort of set an alert, either a mental alert or I put it on StockCharts and say, tell me when this level is hit. That allows me to not worry about what's happening and not fret about what's happening, not feel like I need to keep every moment looking at them, but just let the system tell me when a key alert is triggered, when a key trigger has actually played out. A couple of those triggers I mentioned so far today. The S&P getting above that trend line. That's an important one. I watch that chart every day. The S&P getting above 4,100. I think that would be an important development. Bitcoin getting above 18,000 happened this morning, or today. So that's an important trigger potentially as well. The VIX getting below 20 is one of those ones. So earlier today, I get the announcement VIX below 20, and I have to dig into this chart and thinking about a little further. If you think about what happened in the second half of 2020, the first quarter of 2021, you can see that the VIX sort of settled into this range between 20 on the lower end, sort of 35, 40 on the upper end. You can see that lines up pretty well with the swing highs and lows that you saw in price. Overall, obviously, that was a constructive period. This was, sort of that consolidation phase in September, October of 2020, and then that resolved to the upside. One of the great buy signals of the last 5 years, I think, sort of following through and resolving that pattern, that clear coil pattern to the upside. But you can see that the volatility remained elevated. Only in mid-2021 did you see a continuation of that bull market phase, and the volatility actually came down. And the VIX getting below 20 was sort of that sign that that uptrend was sort of a slow and steady buy the dips type of pattern. That's what's caused me to think differently about 2022. Of course, the trend in the market obviously very different, and I certainly want to acknowledge that. But it's more about the volatility, right? 2021, relatively low volatility year. 2022, more of a higher volatility year, 20 on the lower end, kind of 30, 35 on the upper end. We can see again the extremes when we've hit these shaded areas in 2022. You can see it lines up with the major turning points in the S&P over that period as well. Now, one of the things we've talked about, and we talked about that in August when the S&P was testing the 200-day. We talked about that in December when the S&P was rallying again in late November and thinking, is this enough? Is there enough upside momentum? Is there enough of a signal that the upside is going to continue? And one of the reasons why I did not feel very high conviction about that idea is because the VIX remained above 20, kept bouncing off that 20 level. And that was more signifying or more clearly related to previous market tops in 2022. That's potentially changing. This week, we actually see the VIX breaking below 20. Now, again, a number of these times it briefly went below and then quickly went back to the upside. But the market rallies further. The S&P gets above 4,100 and the VIX remains below 20. All of a sudden, this is less of an uncertain, choppy bear market phase. And this is something very different. Again, on the individual stock basis, I think we're seeing some of those differences already, but the VIX has been a sort of a rare holdout. You're actually starting to see it potentially give a key signal. So watching the VIX remain below 20, I think would be a pretty important signal to watch. Just to wrap up our segment here on sentiment, wanted to highlight the fact that you did have an increase in bulls on the AAII survey, around 24%. We did have a decrease in bears, just below 40%. That's the first time we've been below 40% since early November. So again, investors starting to be a little more believing in this uptrend. The spread between the two, around 16%, is pretty much the mid range of where we were for most of last year. So no real signal there. Finally, just to finish off, wanted to remind you when we're thinking of taking a step back, and a lot of my conversations recently with Tony Dwyer, with Jeff Hirsch, have been more take a step back type of thinking, which is really, really important at the beginning of the year. Couldn't help but notice looking at the Ridex flows. If you look at the Ridex flows in early October, and again, this is how much investors in the Ridex family are on the defensive side versus the offensive side, tilted very defensive in October of last year to the almost exact same level as we saw at the March 2020 low and the December 2018 low. So if the October low ends up being the low, which I still think is a question mark, this indicator may be one of the great ones to continue or to acknowledge as having a really good indication of that bombed out sentiment, because investors were as defensive as they were in previous cyclical bear low points. We need to wrap the show here and go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. Looking at the long-term relative strength between gold and the S&P. And again, we had a lot of fun recording Charting Forward 2023. It was a really cool conversation with a lot of great insights and good takeaways. I would encourage you to check that out tomorrow. We're getting it all ready for you. But one of the charts we talked about, I think Tom Boley maybe highlighted this one, and we all sort of weighed in, was looking at the relative performance of gold and S&P. This was one of the places where we had a bit of a disagreement as a roundtable. Some saw this emerging strength in gold as the beginning of something much further, as a recognition of this super cycle bull phase for commodities, and that gold had so much more upside. Look at when this ratio got above its 200-day moving average in 2001, and then had this incredible run from 2001 to 2012 of outperforming stocks. That has not been the case recently, where gold has just consistently underperformed. Is this the beginning of something further? We have to get above the 200-day moving average first, and we're potentially getting it there. That's, by the way, a weekly chart using the 200-week moving average. I don't mean to misspeak there. Chart number 2 is looking at volatility. I have my chart of the VIX that I often show. Bear with me for a moment. I'll explain what this is because I've muted sort of the raw data. This is the VIX plotted upside down in the top half. This is the S&P 500 plotted right side up in the bottom half. I'm taking a 50-day moving average of the VIX in green. I'm taking a 50-day moving average of the S&P in blue. Look at how closely these two moving averages are related. When the S&P goes higher, it tends to be on lower volatility. When the S&P is coming down, it tends to be on higher volatility. And again, this is plotted inversely. It's been a beautiful indicator over the last 8 or 9 months. So far, volatility coming in. So far, that means a bullish sign for stocks, and I'd watch to see if that continues. Finally, we have to recognize the emerging strength, as Tony Dwyer and I were talking about. Regardless of the big picture macro environment, these long-term trends, thinking about recessions and yield curves, there's no denying stocks are accelerating to the upside. Airlines were in the stories today, with the Jets ETF making a new swing high, breaking out of an inverted head and shoulders bottoming pattern. Folks, that's the show for today. Special thank you to Tony Dwyer of Canaccord Genuity and Dwyer Strategy joining us from New York. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, be safe. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.